The fixed income conundrum. This is the list of alternatives you have for your clients. BlackRock last week made a very interesting point, which I've shared in every single meeting or presentation I've done this week. If you have strict definitions for each of the asset classes you invest for your clients, you are missing the bigger picture. At the end of the day, your clients don't care how much you put into each type of asset class. They want to know what the best opportunity set is. And that got me thinking. In 2 meetings we had here yesterday in Melbourne with researchers, they said, Jonathan, why don't we think about it this way? How about if we take your fixed income strategy and we put it in the equity pool? Anyone thought about that? Because here's the question. If everyone in the fixed income space is generating something like 4.5% for you, for your clients, when you take away your 0.8 or 100 basis point advice fee, and then take away another 60 or 70 basis points from the platform fee, what are you giving your client? You're giving your client heightened risk with a term deposit return. And so advisors are taking 2 different angles. They're either finding the lowest cost option, or they're saying to the client, you know what? If you want to give me $1 million to invest, give me 700 grand, take the 30 grand, play into a term deposit, and I'll invest 100% of the 700 grand you give me in growth assets. And that's a viable way to go too. And that's something that's getting people to think. Because infrastructure, as we all know, even for our firm, we've invested all we can into infrastructure. And the yields were great. The yields are now lower because the capital value has increased. Inflation-linked bonds in a world where there's no inflation, investment-grade bonds where there's not enough spread for anyone to justify their own existence, and cash and hards funds you may use because you need to fund a client's pension account. But other than that, what options do you have? With that, I want to introduce our third fund manager for 5 minutes over a video. His name is Gordon Ip. He is the head of fixed income for Value Partners, and he's going to talk you through what we invest in that region.
Hi, I'm Gordon Ip, Head of Fixed Income at Value Partners. Just a little bit of introduction of myself. I have been with Value Partners since 2009, and I have more than 15 years of investment experience in the global fixed income market, ranging from interest rates, credits, as well as securitized products. The fixed income here at Value Partners consists of 9 investment professionals covering the entire Asian credit space, including Japan, Middle East, and the Commonwealth independent states, particularly Russia. Driven by investor design for yield and our ability to provide unique products that satisfy those needs, we have seen substantial growth in our fixed income business over the past few years. Currently, our team is managing more than $2 billion of fixed income assets for our clients. Our investment philosophy is very simple. Actually, our name says it all. We are value-oriented fixed income manager, and our job is to find value in the global credit space through our rigorous process of bottom-up credit analysis. Our process is both quantitative and qualitative. First, for each mandate, there's usually a certain return or yield target. We scan our investment universe against this yield target to arrive at a smaller set of bonds that are candidates for inclusion into the portfolio. For those that are screened out, we will keep monitoring. But for those that are screened in, we will conduct rigorous credit analysis in which the issuer's credit and liquidity profiles, their business models and industry outlook, their financial statement, their management quality and track record, as well as relative valuation versus the peers, will be going through full evaluation in our intensive process. For those that have passed our stringent requirements will end up in our portfolio, and those positions will be monitored and evaluated on a continuous basis. Lastly, as we are an integrated team of both fixed income and equity professionals, the synergy between both teams really gives us better breadth and faster execution of ideas than many of our peers. we think Asian debt is attractive. From a fundamental perspective, implied default rates of many Asian issuers are being priced too bearishly, which don't even link close to reality. And distortion in the market are there for those who want to find them. From a technical perspective, Asian debts are primarily owned by Asian investors, who are very familiar with their own issuers, which make them more steady hand of bonds. Therefore, Asian bond markets often tend to be more resilient than some of the developed markets. In fact, the stable performance of Asian debt markets amid the recent Brexit event provides a very good example of how resilient these markets are. We are very happy with the performance of the Premium Asian Income Fund. Since inception, we have been able to deliver our investors strong income of minimum 6% per annum with low volatility, and we have never missed a distribution. On a total return basis, we have achieved an annualized return of 11% with a volatility of 5.9% since inception, achieving a Sharpe ratio of roughly 1.8 times. This performance is a direct result of our rigorous credit selection process and also prudent currency management. Special situation refers to an investment strategy in which an investor will try to profit from a unique situation or event faced by a company. Those situations include, but not limited to, merger and acquisitions, refinancing, litigation, asset sales or liquidation, etc. This strategy requires extremely intensive analysis and close monitoring. However, if the situation works out to investor favor, these are highly profitable trades. We have been running a small percentage of the fund in special situation strategy, and it has been quite profitable. When there are opportunities, there are also risks involved. On opportunities, Asian credits, especially China property credits, offer good risk-adjusted value compared to credits in developed markets. Limited supply of bonds and ever-increasing demand for yield provide very supportive environment for Asian credits. A continuous low global rate environment also favors fixed income investment, especially high-yielding assets. On risk, investors should be mindful of more aggressive Fed rate hike and the development in Europe following the recent Brexit event. In addition, investors should also pay attention to any idiosyncratic credit events in their portfolio.
So a couple of key takeaways from Gordon's video that I want to explain. First of all, which part of the market do you want to play in? This is the capital structure of any investment across bond to equity. There is no spread available from senior secured debt. You're taking enough equity risk, and have you bought enough hybrids yet? That's my baseline question to everyone in this room. If you buy hybrids, have you bought enough yet? Do you realize that it has an equity-like risk? And your clients most probably don't understand that risk. We are only interested in senior unsecured debt in this portfolio. This is a legal definition. What we're doing here is dialing down significant risk in your fixed income portfolio for your clients going forward while generating a yield that is acceptable by both you and your clients net of all fees. This fund was launched in August 2011, and at the end of this month, we will have a full 5-year track record, which everyone knows is the magical time period for any fund. The $19 million you see there as the fund, it's almost hitting $20 million today. This is the highest level of investment we have invested in our own funds. We charge a basis point management fee of 98, plus a performance fee and a hurdle rate of RBA plus 2%. With a high watermark. It's continental Asia, Middle East, and now includes from the 1st of July, Commonwealth independent states like Russia and Kazakhstan. We pay quarterly distributions in this fund, never missed a beat, and every distribution has been at least 150 points per quarter. Now, since everyone is fee conscious in this day and age, since the 1st of July, we have killed the performance fee. This is the only product in our suite which does not charge a performance fee, because we believe under the fixed income, we need to give you as much value add as possible. In total return numbers, the performance fee has cost investors an extra 100 points per annum over the last 5 years. So we're removing that in totality to charge a flat 98. This is the implied default rate that Gordon was talking about. The blue bar that you see there is representative of the range of the different pricing that the bonds are sitting at. So meaning, the closer that line gets up to 100, there is more bonds in that marketplace that is trading at an almost 100% chance of default. Whereas the number that you see in yellow represents the average of that. So if we look at China, BB rated bonds, the market is implying 27% of that market will default. Note, ladies and gentlemen, that our fund has weathered the storm of 2013 and 2014, where there were emerging market debt routes, in which the reality and the implied default rate are so far different and removed from each other. I also want to make notice to the Philippines part of the market, you see there's no rating next to the country name. Now, why is that? Because in the Philippines, no one believes what the research house says and doesn't need a research rating to buy the bond. Irony at its finest. So where we add the value and why you pay us 98 basis points to give you value add to your clients is because we do not care about the rating of the bond. Hand on heart, how many of you look at the rating of a bond by a major research house and consider that as gospel as to whether or not your client has capital security? We don't. We have 9 investment professionals, including 2 dedicated dealers split between Hong Kong and Singapore, that manages the $2.5 billion of fixed income assets for value partners. And Gordon sits here at the top of that chain, and he started with the firm when they incepted their fixed income strategies in 2009. Gordon specializes in the portfolio management as well as high yield. These 2 gentlemen focus on financials as well as investment-grade debt. This fund contains very little investment-grade debt, and it is effectively 90% high yield, of which 80% is sub-investment grade by a debt rating perspective. The beauty of it is that if I ask you this question, if you're happy to buy the equity of a business today, why are you not happy to buy the bond of the same business if it's paying the right coupon? And this is how the 58 team members with our investment team interact with each other to find the best ideas for your clients. Gordon in 2015 was ranked number 7 out of 500 investors in Asia, and they won Fund of the Year awards, Outstanding Achiever in the high yield space in 2015. Gordon is an incredibly kind-hearted person, and besides what you saw in the video, he does smile, unlike most other bond managers in the world. As of 48 hours ago, we have received our new endorsement by SQM Research with a 4-star superior rating on the fund, which has been upgraded from 3.75 stars in 2015. This is a result of performance as well as us increasing our investable universe as well as increasing the total return to your client by removing the performance fee in its entirety. The total return of the fund, as Gordon mentioned, is 11% per annum net of all fees and 5.8% volatility, which makes this fund have a Sharpe ratio of 1.8. I want you to reflect upon the client portfolios you built today and find out how many funds have a Sharpe ratio of 1.8 times. As I said, we pay quarterly distributions out on this fund because the cash yield is 8.6%, meaning it is very, very easy for us to pay at least 150 basis points to your clients per quarter. In the financial year that just passed, ending 30 June, we paid a total yield or distribution to your clients of around 8%. The yield to maturity of the portfolio is 9.7, which represents that on average, the 49 bonds we hold in the portfolio are trading below the $100 par value. That means that we can get capital gains for your clients on bonds. In a way, you can think that that is a bit of insurance. Secondly, BlackRock also mentioned the other week that people are now buying equities for income and buying bonds for capital gains. How odd the world has become. The time to maturity on the portfolio is 6.3 with the modified duration at 3. Everyone's looking for low duration, so we're providing it. High yield, low volatility, low capital movements, strong income, low duration, with a manageable portfolio of 49 securities. The country allocation, 55% to China and Hong Kong. We try to invest as little as possible in Indonesia because it's an overcrowded trade. Western fund managers that buy into Asian debt go through Indonesia because they think it's a better market, it's less distorted, because China, as we mentioned, is highly inefficient, just like their equity side. And 45% of our exposure is in real estate. 19% of the bonds we buy aren't rated. 55% are B and below. Remember what I said, we do not care what the credit rating is of a bond is, because we can add a lot more value there. So, the two questions that come out of here, because those two stick out like a sore thumb, let's discuss it. Why China? It's a function of the credit market. Most of the Asian credit market is China. 2, people rush to Indonesia instead and overcrowd the trade. Therefore, we'll buy, as you all know in the last 2 decades, we buy stuff that other people don't want to look at. And thirdly, because people don't look at it, you saw the implied default rates allowing us to buy a discount to region. Then your second question would be, why property, Jonathan? We keep talking about property and property blowing up in China, and Yan has shared her views on the situation. So why property? Function of the Asian credit market. 2/3 of the bonds in Asia are property. We have 45% exposure. Is that so unreasonable? Second, it's a simple business and transparent data. Yan and her team have access to clean data through the Bloomberg of China called Wind. And that gives all the property sales data, project data, one after another, in a clean manner for us to evaluate. And thirdly, as Gordon always says, at the end of the day, if your bond was to default, would you rather be holding to property in a piece of land, or would you be rather holding a bag of fish? Non-perishable inventory is very important to us, which gives us a large safety net. These are all very measured and deliberate moves to create a portfolio that can generate true returns to your clients. We surveyed 100 advisors that have never heard of the word premium. And we asked them, what do you invest in for fixed income for your clients? And this was the outcome. I'm not picking on any fund manager here. I'm just surveying the market, and this is the risk and return profile for 5 years. Now, I've asked advisors, I take a guess that in the next 5 years, all the dots you see on this page, including ours, will move to the right and down, representing a heightened level of volatility with a total return lowered. If that is the case, which part of the risk spectrum do you want to take for your clients? And the question that I asked before, would you consider this as part of the growth portion of your client portfolio? There are 3 strategies that are available in Australian dollar terms that buy emerging market debt. Again, these are not available to you anyway, but I want to show you the danger of buying emerging market debt. I've painted you a really rosy picture, but I will paint to you what the danger is. If you're buying US dollar debt without properly hedging your position back in Australian dollars, you'll get a return like this with Goldman's, like this with Lazard, and like this with PIMCO. All three of these funds are emerging market debt funds. And it's not because they have poor security selection. The reason is because they don't hedge anything back to the AUD and get trashed. What we do in our portfolio to reduce the volatility to your client is that we actively hedge the AUD against our exposures in USD. Every single bond we buy is not listed on an exchange or a stock exchange. It is listed on Euroclear, which is the highly liquid global marketplace for bonds, which is multiples times size larger than the equity market. And what we do here is that we found that over the course of the last 20 years, we find a very high correlation between the Australian dollar and the JP Morgan Asia Credit Index, and a very high correlation between the Australian dollar and the economic performance of the Chinese economy. So what happens is that when there's heightened risk in the region and mark-to-market risk hits the overall portfolio of bonds, we're already unhedged. By being unhedged, we take the hit on the mark-to-market, we make money by being unhedged as the Australian dollar tanks in the same direction. And that's the correlation I'm talking about. This is how we generate 5.8% volatility to your clients. There's no secret behind it. We're talking correlation here. We never say we can pick active currency. We're saying we're picking based on a path-dependent correlation. And the last 5 years, with 2 liquidity impacts on the Asian credit space, we have done exceptionally well. So what we have is that we have a portfolio that is well diversified, not the type of portfolio that you saw before GFC, where bond managers were holding 500 corporate bonds, and that's what I call blind man diversification. This fund doesn't have leverage. It's not something strange that you've never seen before. It is a straight bond fund. Our duration is lower than our time to maturity. Our cash yield is lower than the yield to maturity. And we actively hedge the Australian dollar to reduce your client's exposed volatility risk, mark to market and currency side. This fund currently sits on Macquarie Wrap, it sits on BT Wrap, and it sits on Hub24. The next step that we will aim to go to, since we now have a 4-star rating, we will now go to net wealth to have it added on there as well, but the fund needs to have $25 million. We have on the feedback forms written a section asking you if you're interested in this fund as well as what platform you use, because we'd like to touch base with you. We have received exceptional support in the last 2 months as we've gone to market properly with this fund, and we'd like to help you too with your fixed income exposure. Now, that's all we have time for today.